Good afternoon, or good morning, or good evening, depending on where you are in the globe. My name is Jackie Noblett. I am a senior reporter at Ignites, which is one of the Financial Times FT specialist publications. And I'd like to welcome you to the next panel discussion on active and passive due diligence, evolving and now more critical than ever. Before we get started, just a few housekeeping items. Just as a reminder that the sessions will be available on demand for 2 months at crossborder.live.ft.com. You can also head over to the sponsor page to visit the sponsor hubs. We would love to hear your questions on the topic. There's many areas we could get into, and we want to make sure that this is the most useful for you as the audience. So there's a chat box to the right of the screen where you can submit your questions. And finally, feel free to share your thoughts on social media using the hashtags crossborderLU and crossborder2021. To open up the conversation with our panelists, we have Dan Hunt of Morgan Stanley Wealth Management, Axel Lomholt of Vanguard, and Kelly Pryor of BMO Global Asset Management. Thank you all for joining us today. To get started, so that the audience can understand a little bit of your background and your view on the topic, I was hoping that, and Dan, we can start with you, your views on how best practices in due diligence for fund and managed selection, how has it changed, let's say, in the past 3 to 5 years, and then in the past year with COVID? What has changed, or how has COVID accelerated those changes? So Dan, and then we'll go to Axel and Kelly to get your brief views on the topic.
Sure. Thank you, Jackie. Thanks everyone at the FT for the opportunity to speak today. So yeah, in terms of how due diligence has been changing, I mean, we think of due diligence as changing for multiple reasons, due to performance, due to client demand, due to regulatory needs, and all of those things have had specific trends in the last 3 to 5 years. If it comes to, if we think about the regulatory side of things, best interest regulation in the United States is one of the factors that's driven us to increase our coverage. The performance side, if you look at the passive versus active performance in this cycle, we have augmented and learned from the passive due diligence perspective that is a critical element there. So I would say technology is another factor, which I think we'll discuss later. But these are some of the broader trends. If you look at COVID, obviously that has changed the degree to which you can have direct meetings with managers. That's an important component of our due diligence process. It's something that is now much more virtual than it was in the past. However, that continues to be a portion of what we do. I think it's more of a challenge potentially for things like operational due diligence. However, a lot of what we do isn't necessarily require a face-to-face meeting. So,
excellent, Axel.
Yeah, it's a good question. I would thank you very much for being here. As I said earlier, I'm in quarantine right now in Hong Kong, so any interaction with the outside world is fantastic. So thank you. But yeah, I mean, just briefly, I mean, I work for Vanguard, and we manage about 7 trillion across all kinds of asset classes and instruments and so forth, which I think most people know. What most people probably don't know is that we have about 800 billion in sort of sub-advised on sub-advisors management. When I sort of think about the past couple of years, I don't think a lot has really changed in the way that we sort of oversee our fund managers. At the highest level, we still believe that discipline and low cost and top talent are crucial, and success is sort of measured over the long term. That's our approach to our own active management within Vanguard, and that's the way we hire advisors for particular strategies. Again, when I sort of think about overall process, there's sort of still three major components to it. It's the selection process, it's oversight, and it's retention. And again, I don't think a lot of that has changed over the past couple of years. So yeah, I mean, I think the bottom line is, from our perspective, Jackie, I don't think a lot has changed.
Great. Kelly?
Hi, and thanks from me too for allowing me the opportunity to speak. With regards to things that I would highlight that have potentially changed, and maybe this is slightly longer than over a couple of years, but something I think we've certainly noticed is, yes, the points with regards to technology advancing. I think we can talk maybe about ESG and how that's influenced perhaps the way people are assessing funds. But something I would highlight maybe is the sort of homogeneity, if you like, of processes, which is perhaps taking away some of the art when it comes to how people are communicating about their funds. So as a fund selector, you really want to get under the skin of what's helping a manager make a decision, a team make a decision. And I think where there's more mass production, perhaps from larger companies, you're getting that lost in a lot of the communication. Obviously, you know, the phone calls died as a medium of communication. And, you know, we talk about conferences like this, you know, it's great, but actually, you know, having that face-to-face contact, obviously COVID has taken that away. But, you know, we have seen the rise of standardized documentation, you know, client portfolio managers, and just generally being taken away from those decision makers. You know, we're lucky, as I'm sure the other guys on this conference are, that isn't necessarily too much of a factor, but I think it's something from an industry perspective that needs to maybe be thought about in terms of how things are communicated, that edge that really, you know, makes a difference for an individual fund or manager, and how that's communicated, I think is something that groups really need to think about as to, you know, how they talk to clients about that.
To pick up on something that Dan mentioned, Kelly, do you think that that homogeneity comes from the influence of passive in the overall due diligence process? I know you focus on active, so I'm just curious whether elements of whether it's the quant or just, you know, everything being reduced down to kind of fees and, you know, performance, whether that has kind of filtered in.
It's an interesting question, actually. I wouldn't say necessarily. I think that maybe it's to do with the industry itself, and you know, with M&A bringing together companies and this need to maybe reduce cost, and therefore standardize your literature that you're actually producing and the like. And it's just, somebody made a very interesting comment to me about what's happened in the post-COVID, what happened in the COVID era, that, you know, it's been great for efficiency, but terrible for creativity. I think the same could possibly be said of some of the documentation and just generally the communication. It's, you know, it's very efficient to produce standardized documentation, but you end up going down to the lowest common denominator. And I think maybe that's generally true of you know, of the industry. You're potentially losing some of that spark, like I say, because you want to sort of you want to provide for all in terms of how you do things. I'm not sure if that links to the passive necessarily. I just think it's the way that, you know, groups think about how to get the most done with the least amount of effort potentially.
I see.
I think
so Dan,
Jackie,
I did want to.
No, I was just going to throw in there quickly, Jackie. I mean, I've been around in the industry for a long time, and it is interesting because, you know, 15, 20 years ago, there wasn't a lot of sort of effort put into passive due diligence. And I think it's amazing what we've seen over the past decade. I mean, many ETFs and other passive mutual funds are almost going through the same due diligence as active funds. And I think Kelly just brought up ESG, which I think is a great example of something that the industry is going through right now. Even though it's a passive fund, I mean, there is a lot of scrutiny going into how are these indices actually built, and if they really reflect sort of the underlying ESG factors. So I think that's one of the big changes is the due diligence around passive funds and ETFs over the past decade.
So when you say that due diligence is increasing or really has gone through the same rigor as you know, active funds, are you talking mainly on the index themselves and like how that would fit in with a particular model or a strategy, or is it more of the operational due diligence in terms of tracking error and you know, trading costs and that sort of stuff?
Yeah, I mean, I think that's where it started. I mean, and that's where it started probably a decade, 15 years ago. We sort of started looking at just the index and how was index constructed. But my sense is what we've seen over the past decade is now actually, people are spending more time on assessing the underlying ecosystem that's supporting these funds, even fund managers, what systems are using, trading, how you trade indexes are pretty significant. That can make a huge difference to your performance every year, right? So we didn't see that before. Even, passive funds are being rated now. ETFs are being rated and so forth, which you just didn't see 10 years ago. So that's one of the big changes.
Yeah,
And
absolutely. I mean,
since
they've
Dan,
become more important. I was going to say, I mean, obviously, flows, performance, they've become a much more important component of most people's portfolios. We've seen them across distribution channel from, corporate retirement to robo-advisors to whatever the case may be. So passive becomes more important, more focus on due diligence. It makes sense. I mean, I think a lot of the due diligence we talked about here is due diligence of the index, and you talk about smart beta, you talk about ESG, you talk about, is that index itself a worthwhile investment, and how does it fit into an investment program? And you have to sort that out. Obviously, active due diligence remains a tougher hurdle. There are a lot of the same factors you should be looking at in passive. You should be looking at in active, and then you have the additional factors of understanding the investment process and quantitative due diligence, the fundamental due diligence, et cetera. So, but agreed that passive due diligence has definitely become much more emphasized, much more rigorous. And much more important to clients.
so let's put a pin in the ESG discussion. We'll get back to that. And let's kind of go to the opposite of kind of the quantitative index and talk a little bit about manager risk. The Woodford scandal obviously raised a lot of concerns and kind of made people aware of maybe some of the soft spots in active manager due diligence. Kelly, what do you think are some of the biggest lessons specific to the Woodford scandal? And then if anyone else wants to jump in, just about kind of star manager or kind of breakaway manager due diligence process.
Well, I think obviously what's been talked about hugely is just, the liquidity and matching the underlying structure of the vehicle with the underlying assets. And I think that's kind of a given and is being looked at. And I don't think I have anything to add on that necessarily in terms of the issues there. I think that one of the things that we should be thinking about when it comes to due diligence is looking at, managers get given new mandates and move to new shops all the time. And that's, that can be an incredibly exciting time to get involved with a manager. But the point is to look at the mandate that individual is moving to, and actually, is that exploiting, their best skill set? Is that what they've done in the past? Is it a small element of what they've done in the past? And is that now becoming a big part of what they're doing in the future? And to think about, obviously, risk budgeting and thinking about what they've done in the past, and is it relevant? Again, there's a huge amount of emphasis put on past performance track records, but nothing stays the same. No manager, a successful manager will, in performance terms, will obviously attract a huge amount of assets, and that in itself will change how those assets are run more often than not, because it will obviously increase the liquidity issues and the like, and they will, again, very successful people then become man managers because they can't do what they did before by themselves. And I think this is one of the things within our industry that really needs to get focused on. And again, that is a lesson to be taken out of this, I suppose, is just stand back and actually understand what it is that's, it is changing with the new setup. I think one other factor as well with regards to this is just understand who you're investing alongside. And one of the issues with these particular products was that they were pushed by platforms and by lists, which means that you have a lot of investors that are following those recommendations, which is all well and good on the way in. But obviously, when things change and that recommendation changes, again, there can be some issues with regards to liquidity because, they're just following a recommendation from a platform, which is, again, a very difficult thing to monitor. So they're the two sort of key takeouts, I guess, from that particular situation that needs to be thought about.
Yeah.
I would just add, I mean, I think the amount of idiosyncrasy associated with that particular incident is instructive. There's, as a due diligence analyst, as somebody who's trying to give investor confidence to invest in something, obviously you need to look at red flags including liquidity mismatches, red flags including kind of potential star manager type thing where there are flows associated with it. But a liquidity mismatch and a bank run are as old as capitalism itself. But in any particular instance where there's a blow up, there's usually a lot of things that are unpredictable that happen. So it is difficult to know when red flags are, something to consider and potentially allow access to versus something that means you shouldn't, your investor shouldn't be near that thing. So that is always a challenge, and there's art and science involved in that. But clearly there were a lot of red flags involved in that particular situation.
Yeah, the only thing I'd add there, I think, Kaylee, you made a really good point there, which I think is an important one, is that that fund was pushed very hard to sort of retail platforms and ISIS and so forth, right? Which is really unfortunate because I don't think that really reflects sort of institutional like fund due diligence, right? So I'm pretty confident you guys would look very similar to this, like we would at Vanguard, but we would look sort of more holistically, at the overall firm, the people, the philosophy, and the processes, right? So you look at the whole ecosystem that's supporting. And I think in most companies, and I don't think the Vanguard is very dissimilar, is that if you have a staff fund manager and everything relies on that individual, that would absolutely raise a lot of flags. And you would think about, can this really be a partner for us in the long term? But that's sort of coming from an institutional perspective or maybe advisor perspective. But it is unfortunate because you have people that are investing in these funds that they don't have access to this fund due diligence. And I think that's what we feel, the end investor, is that retail investors at the end of the day shouldn't really have access to some of these funds, right? I think it's a really good point, Kelly.
And there's also a failure of benchmarking there. There is a certain extent to which, a manager taking more risk than their benchmark is pretty common, but it's something that you should be careful of when evaluating their performance. And the liquidity mismatch is risk.
And there's an element of timing element, sorry. So much of the conversation was about the whole point, patient capital waiting for things to play out. And again, it's about the underlying investor base actually understanding that. And I think it was mentioned in earlier on about timescale of investment. And I think this is something that the industry itself and just generally people have become much shorter term in terms of how I'm not necessarily saying that this particular situation we're talking about now can be forgiven because of this, but I think a challenge that we actually face at the moment, just generally as an industry, is the expectations of timing for outcomes to actually occur. Again, maybe we can develop on this, but it's something that I think is really should be focused on in the due diligence perspective.
Yeah, I think that the point, and before we go further, I just do want to remind our viewers to please submit questions if you're interested. We want to make sure that we address any questions, concerns. We don't miss anything that's important to you. So please do that. But I want to go back to kind of looking at this, and I guess this is passive and active. How much does due diligence really have to be tailored and not homogenized to your particular client base, whether it's a high net worth investor, whether for Vanguard, ultimately you're bringing these managers together in your active funds and, addressing it to a retail client that just puts, in some cases, just a couple of $100 into a fund. So, I don't know, Axel, if you have any thoughts kind of specific to you're really addressing that retail investor. You're kind of doing you have to do all of that stuff because, Uncle Joe and Aunt Sally are not going to be digging into these managers like you can.
No, absolutely. I think it's a really good point. And when you have 30 million clients in the US, and if they all put in, $1,000 every month, it all adds up, right? So we take our fiduciary responsibility incredibly important. I could spend a lot of time talking about this, but I think there's sort of three things that we sort of very quickly that we look at when we sort of look at due diligence. One of them is around performance, and guys would know this, but we certainly look beyond performance, and we focus on those four drivers that I mentioned before: firm, people, philosophy, and process. Because strong performance could be a matter of luck, and poor performance could be a result of bad luck, right? So you don't really know unless you have seen this over a long period of time. You can't really say with certainty, are they really performing well? We believe in sort of giving our managers time, and we're not a publicly traded firm that give us some privileges that we can give us time, so our managers a bit more time. And we believe in sort of stability. The other thing that's big for us is partnership. Our search approach is very exhaustive, and would take a long time to find our managers. And we when we take on a new sub-advisor, we build very strong partnerships with them, to the extent that we even sometimes have them with succession planning and so forth. And we appreciate that active investing is challenging, and styles go in and out of favor, and underperformance may occur. For us, it's important though that the firms stay true to those four drivers of performance, that we sort of select them on in the first place, and that's where we spend most of our time. So we can have long phases of underperformance, and we're happy with that, as long as they stay true to those underlying factors. And then finally, from our perspective, once we have hired a manager and they're on our books, there's sort of two things I think that are playing out in terms of having systematic oversight. And one of them is, this is where technology comes in. I mean, we have firstly sort of really advanced technology. We sort of look at sort of performance attribution and risk reporting. But the other thing that the teams are spending a lot of time is what we call holdings-based attribution. And spend a lot of time on really understanding the positions the managers have taken over decades and years, really understand how they build the portfolios. Because what's important for us is that if you're a value manager, then you should have exposure to value shares. And we don't really want to see a style shift. So if you're truly a value manager, we would expect you to be holding value shares for a long period of time. It's not your fault if value goes out of favor, or if value is underperforming. We can't go and be really critical to a manager. Hey, you underperform. Well, I'm a value manager, we're underperforming, right? So those are sort of the three big ones for us: is looking beyond performance, having really strong partnerships, and then this attribution analysis of how they've been doing at these couple of levels.
Yeah, I would say also,
Ben, do you want to?
yeah, sure. I mean, obviously, I think, I agree with a lot of what Axel mentioned in terms of the importance of understanding people and process, and aligning decisions and positions with the process, and understanding that, what comes out of that at the end in terms of performance should relate to, your understanding of what their value add is. But, I also think that, the capacity for, when we look at performance, we're not looking at, who performed the best, or even kind of like on a kind of a risk adjusted basis. But there are smart markers and things that tend to predict better performance going forward, and good risk control. And so, we try to innovate, especially on my side of the house, where we do the quantitative work. We do look for markers of things that would indicate that a manager is more likely to have risk-controlled performance, and that tend to perform better. But agreed that when you are making a high conviction decision, it's not something that you should be turning over very quickly. So there should be a lot that goes into that decision. It's very difficult to tell in very short periods of performance, or even 1 year, multiple years, if that is a result of poor process and poor decisions, or just the markets working the way the markets do. And you want to get that decision right, because the more you're transacting managers, that just creates costs for clients, and it doesn't actually improve their outcomes.
And just to follow up on that, I mean, how much also, if you're building models, that it's the manager, but also the fit with what you are trying to accomplish. You could there's a lot of different approaches to value, and it's got to fit with your house views on, what even value is defined as, or growth, or we'll get back to ESG or ESG, something like that.
Yeah, it needs to fit very tightly with the decision makers for the managed portfolio, whoever those may be, right? And then the advice and guidance that you're providing so that it's a proper implementation of that. And to your point before, I think that also needs to respect client segments. I mean, we do have, there are things to keep in mind when you're dealing with a retail audience that are different than, an institutional audience, that are different than an ultra high net worth audience. In terms of the types of product you source, and in terms of what you can expect of the experience of the client and what that means for what you should be selecting.
Great. So I want to go back to technology, and we did have a question that came in from the audience about, using new technology for dynamic due diligence, dashboards, KPI monitoring. Maybe we can address those specifics within kind of the broader context of, where are you using technology the most in your due diligence process, and where are the more interesting areas of technology coming into the fore? Kelly, do you want to take a crack at that?
Yeah, I can do, absolutely. In terms of how we use technology, I think it for us it's a tool in the box, so to speak. So for us, understanding actually, how a manager has made decisions through the use of attribution and look through in portfolios, and then taking that as part of the discussion with the individual. For us, that's the crucial use. It's about understanding that and having a more in-depth conversation, I suppose, because you're already starting on the front foot in terms of seeing what's been. I think that much of the points that have already been made, really, I guess it's putting that in context. So again, what's been in terms of the market environment and the overall structure. And you talk about holistic, Axel, a holistic view of assessing a manager and what's actually created performance. Again, it's being aware of those factors as opposed to just purely relying on technology and assessments in those respects to actually guide you too much. So, I mean, we're potentially different to the other guys on the call here in terms of us being much more fundamental in the way that we actually do the assessment and the softer factors, I suppose. But for us, as I say, technology is one of the tools in the box as opposed to being the be all and end all, I would say.
Dan, I think on a previous conversation, you talked a little bit about, using technology to kind of gut check some of your more fundamental evaluations.
Yeah, and I think part of what we just spoke about alluded to that, right? The performance attribution, the quantitative signals. I mean, I think in the vein of kind of what's changing in due diligence, I mean, obviously some of the new technology that's being harnessed elsewhere, we found has applications for due diligence, meaning specifically big data, machine learning, deep learning, natural language processing. I mean, there are large data sets to look at in the due diligence world. And we've begun doing that, whether it's, filings, holdings data, transactions, performance information, and the confluence of those things. We also, even due diligence reports themselves, even analyst reports themselves, can have potentially information content. So some of those techniques actually hold out some promise to, be able to provide what we would call an orthogonal signal, an independent signal, meaning you have your due diligence analysts. Some of the technology, some of the quant work we do is just to inform them such that their process is more robust and they can ask specific questions about what the manager's been doing. But when it comes to selecting from among a large universe of managers, you can probably find ones that due diligence analysts like that have very good quantitative evaluation purely from a modeling perspective, and ones that don't. So the ones that do, presumably that will increase our conviction in those choices. So I think those are really interesting fields for the future of due diligence.
And then Axel, I know you do a lot of ongoing due diligence with the portfolio review department. Are you using a lot of technology like this questioner asked around kind of dashboards or monitoring of, KPIs or other metrics? I know you also do performance-based fees for your sub-advisors. So I don't know if technology plays into that.
Yeah, yeah. I mean, I don't think I really have much to add over what Dan and Kelly just said. I mean, it's pretty clear that the tools that are available now that allows us to unpack portfolios have come a long way, and we do a lot of development internally and build our own proprietary systems, and we buy in all the tools and stuff. So you can analyze these portfolios to like there's no tomorrow. So I don't really have much to add. I think though this is probably more a broader comment. What I think is really interesting when we sort of talk about technology is sort of a robo-advice portfolios that are buying active funds and passive funds. And I work in Asia at the moment, and we're knee deep in this, and we see how robo-advice portfolio built in almost real time, right? And where due diligence is done in almost seconds, right? And I think at some point that will sort of move to Europe and the US, and it'll be really interesting to see how that's going to impact the way we sort of do fund due diligence, because we got to do it very quickly, and that's something that we do with our JV in China right now. Sort of see how they do fund due diligence, which is very different from everything I just said before. So that's how I think technology is going to play a big part.
Excellent. So I promised we would go back to ESG, and now we will go back to ESG. ESG is interesting because we have three different regional perspectives: Europe, the US, and Asia. And each region, and even within that region, there are wide kind of stances on where we are in the ESG spectrum. So I guess first, from a due diligence perspective, um, how important is it for due diligence professionals to really define what you're talking about in terms of ESG, how that matches up, in Europe with some of the regulation, so that you can have that conversation with a manager about the various ESG aspects. Kelly, do you want to start with that?
Yeah, sure. I think that we as an industry have got a big challenge ahead of us. I think we've come a long way. Obviously, ESG investing, or ethical as it was called when we 20 years ago or something, when we first looked at ethical investing, as it's really moved on. But I think that there is still a way to go in terms of defining terminology, and therefore the sort of common application of that from individual managers. I know from clients' perspective, what they want is, they want to do the right thing. They want to invest in the right way. But actually knowing how to do that, when you actually look at the spectrum of different offerings out there, and the way that they define them within this universe is still incredibly mixed and confusing, quite frankly, even, as I say, within Europe, where this is, well defined. And I think that the big blurred line is this intentionality aspect of things. So, obviously we can all make reference to things like, the sustainable goals from the UN and the like. But again, I think the theory is brilliant, but I still think that there's a way to go in terms of actually the application of this, because I think that there is still a relative amount of cynicism with regards to how these things are applied, and greenwashing is obviously a big factor that needs to be watched for. So, we're getting there, and it's, any push in that direction is obviously a positive one. But I think that for this to really take hold, and every manager has an ethical slide, and every manager is trying to do the right thing. But again, it's this intentionality, I think, that's an intentionality point, I think, that's really one that needs to be defined. Whether it's about KPIs being set or something, I don't know. But yeah, it's a good push. It's it's a good thing, but we're not there yet.
And Dan, I know that sustainability impact investing is a huge goal within Morgan Stanley with wealth management. But the US is also in an interesting space because you have a lot of interest among particularly younger investors, and then you have, in some cases, the opposite of Europe, where you have the government, DOL or what have you, really asking about, whether this is a pecuniary, a performance-based factor or not. So how do you kind of, in your due diligence process, really balance what your clients are looking for, what Morgan Stanley as a firm believes in, and then all of these other aspects that kind of muddy your ability to actually execute on that?
Yeah, I mean, just to clarify, I mean, sustainable finance is a big deal for Morgan Stanley across all of our divisions. We have the Institute for Sustainable Finance. We actually, as part of our process for evaluating due diligence, evaluating alignment of values of a client portfolio to stated values, we have data that's being generated by MS & Co, by the sell side analysts that are looking into balance sheets, that are trying to get a handle on the degree of impact and the alignment with various themes that you have. So, I mean, I think, this is a big deal. I think it's a big deal across the industry. I think it's important for several reasons. I mean, the first of which is simply you can think of it as a signal, like any other signal in an active management context. And that signal has performed really very well this cycle. Actually, it's one of the few bright spots for active management, if you can call it that, has been impact. And, so I think there's, a degree to which it doesn't really matter to some extent, how true it is to values when you think of it from a pure performance perspective. But obviously, the people that are most interested in ESG are the people that are thinking of it in terms of values alignment. And for those people, it becomes very important. It becomes very important to make sure that there is a proper alignment of if they say they express some climate change value or some religious value or whatever, that there is an alignment between what they're investing in and those values, and you need to be able to state that very clearly. I think the industry has made incredible strides in that direction. MSCI recently redid their ratings. As I said, various institutions, including our own, are putting their own research muscle into it to sort of get better at understanding impact. But it's very difficult. There is no objective single way of looking at impact across the industry. And I'm sure there's a lot of gray area. So it is a challenge to make sure that we get closer to objectivity in how we define these things in a way that gives clients confidence that when they're investing in ESG, they're getting what they're investing in.
And obviously more data out there, and standardization. This is a global issue that is trying to be addressed. And, there's a lot of different opinions. Coming to a standard can be challenging. So I want to take the last 10 minutes or so and get to more audience questions and answers. If you do have questions, please do submit them. We'll try to get to as many as possible. But there's one question that came in about using human intelligence with performance, or just the human element, and how do you deal with the need to do it remotely with COVID? I think we've addressed this kind of in aspects, but how do you really get to kind of the human intelligence side? Axel, do you have some thoughts on this?
Yeah, I mean, as I said earlier, it hasn't been an issue for us at Vanguard because with all our sub-advisors, we have extremely long relationships, and we build relationship with many of these sub-advisors long before we even invest with them. So my understanding is it hasn't been an issue at all that we sort of gone through this COVID. Ideal, no, but it hasn't really been a big issue for us.
Dan, I think you mentioned kind of it makes operational due diligence really hard when you can't, do a site visit. So how are you navigating that?
creatively. That operational due diligence is a big deal for alternative investment in particular, and obviously, site visits and being able to, be unpredictable and whatnot is important. You can't replicate that exactly without being able to visit on site, but you can do your best, right? Which is essentially what we're doing. A lot of virtual things. From the perspective of trying to replace that. In the fundamental sense, I think it is also important to have contact with people. I mean, that's certainly our policy. That there needs to be a lot of manager contact in going through those long assessments that result in high conviction being bestowed on a manager. And so, you replace that. That's a little easier to replace with virtual meetings.
And Kelly, I don't know if you have anything to add.
Not so much. I mean, I think it's an interesting dynamic when you talk about COVID and the impact of that. To be sort of invited into somebody's home sometimes can create quite a different dynamic in terms of the conversation, and actually can break down barriers. I've found that incredibly interesting, actually. So, yeah, it's on the one hand, I think you'd think it would actually make things more difficult, but we've found in many instances that it's relaxed people. We spoke before we came on about sort of children running into rooms and dogs barking and the like, and that it does definitely bring a different element into a meeting. And ultimately, as a fund selector, and you're not looking to catch people out, you're looking to relax them and for them to be able to explain how they've made the decisions that they have, and I think it's helped in some circumstances, to be honest with you. It's been really quite interesting, whether that's an element of human intelligence or just human interaction. But it's certainly an interesting element, I think. And it has increased touch points if you want them, because it is easy for people to jump on calls and meet other members of teams and the like. But what you don't get is that feel when you walk into an office and the sense of a culture of a company or how a team works, and you can't see them necessarily interacting in the way that you maybe would do when you do a site visit, I would say. So, yeah, it's not utopia, but there are positives and negatives to draw out of it, I would say. So, yeah.
Does this at all either help or hinder, the effort in terms of diversity, for diversity in the managers that you look at, or diversity? A lot of people have diversity, inclusion, and equity goals within their firm. So I'm just wondering if that helps or hinders, because sometimes you can't really assess that diversity.
So we've begun emphasizing that more, and we have a lot of initiatives in that regard, and we haven't found that to be an impediment to ascertaining diversity. I mean, you really are looking for your frontline point people, your owners, things that are generally known. I mean, I guess from point of view of verifying, from that perspective, there maybe it would be better to be able to visit an office, but we are looking for more hard and fast quantifiable things when we look for D&I as a representative in managers.
Thanks. The question just came in about ESG and cost. So, how do you manage that? Do you put ESG funds in a different kind of metric in terms of what's appropriate for cost and fees? Axel, I know that fees are extremely important to Vanguard, so I'm wondering how you kind of balance the two.
It would be remiss of me of not talk about fees and costs at some point. So thank you for bringing that up. Hey, listen, I think this is an interesting one, Jackie, because, and this goes back to how do you define ESG? And I myself even find it confusing sometimes, because at the highest level, there's sort of three parts to it. One of it is that you integrate ESG techniques into the way you manage portfolios. That's one way of applying ESG to fund management. The other one is excluding securities, and you select an index and you tweak that index. And then there is ownership, right? And how you actually actively participate in voting in companies and so forth, right? But I guess what I struggle with a little bit, those are three very different ways of building, designing, and managing ESG funds, but they're all ESG. I think Kelly made a good point earlier, is that we are sort of all calling it ESG. And my one concern that I have is that that's what we saw with ETFs. 15 years ago, ETFs were an extremely simple, straightforward vehicle, and now there's probably 100,000 ETFs, right? And how do you select the right ETFs, right? So we don't make it easy for investors, and now obviously we as an industry are under pressure. So now there's hundreds of ESG funds coming out. I'm not entirely sure. And then coming back to your point is that what's the right value? What's the right price, the fee for these funds? Because they could be materially different, right? So I think it's a good question, and something that I think we as an industry need to really figure out what fee we put in these funds. It's a good question.
Anyone else have any thoughts on kind of fees?
Yeah, I mean, fees are obviously, important. I think whenever you get a new product area, a new type of exposure, fees tend to be higher, and they tend to come down with competition. But we are looking to be able to provide clients choice, and certainly when it comes to ESG, that's a big part of it. And so, if the fees are elevated, you're going to look at those on a relative basis from a point of view of choice. Now, we haven't been in the business of saying, okay, well, from a purely, it's an option. It's a guided choice that an advisor will make with their client. It's not a choice that we prescribe. But I think Axel makes a good point on identifiability, and I think we've certainly struggled with that as well. And we spend a fair amount of time thinking about not just ESG as some broad category, but what specific themes, and how does a name or a fund align itself with that from the point of view of its stated principle, from the point of view of its holdings, from the point of view of its business activities and revenues. So I mean, you really do need to get to that level, but it is a wild west to a certain extent now, and that means it requires a lot of due diligence.
So we only have about a minute and a half left. So rapid fire final question. Just very briefly to each of you, what will the next 5 years hold for active and or passive due diligence? I know that's hard to get into just a couple lines, but I'll go around. Kelly.
Goodness. Hopefully some more volatility, and that active can benefit from that, I think would be my key takeout, really. Obviously, we've been in some quite unusual markets certainly in the last few years, but post-global financial crisis, which hasn't been easy for active. So that would be my sort of finishing statement, I suppose, really, in terms of the next 5 years. We can but hope.
Dan?
Yeah, I think some of the technology that I talked about before is going to become more prominent as a component of due diligence. And I would agree with Kelly. One thing we didn't talk about is it's been a very tough cycle for active. That's had a lot of implications for how people invest and whatnot. And I suspect, as a house view, that some of those trends are likely to reverse. And we'll see active reassert itself in terms of its value in portfolios, and that will be an opportunity for people to think about how do you put these things together a little bit more intelligently when it comes to active and passive.
And then last word, Axel.
Hey, just finally, yeah, I'm super excited. I think globally we're seeing investors are getting way more actively involved in their investment decisions. So I think that bodes for a great future for us.
Excellent. Well, thank you so much to Dan, to Kelly, and to Axel, and to all the audience questions. So next I want to introduce Katie Martin, and she's going to have the next panel going on bonds, the new equities, in about 10 minutes. Thank you.